And, services rarely fall unless we are in a recession. And you can see evidence of a kind of rolling recession, even in this metric, starting in 2022. So we think this response, units falling, is going to take away the incentive for companies to continue to push tariffs through in pricing.
Hey guys, welcome to Everyday Finance. A direct rebuttal is provided by Cathie Wood in response to the growing speculation that quantum computing poses an existential threat to their cryptocurrency, Bitcoin. In a scathing critique that she delivered during an interview with CNBC, Cathie Wood referred to the alarmist rhetoric as nothing more than a marketing ploy that was crafted by opportunists who were promoting questionable quantum tokens. He argues that the premise that companies such as Google or Microsoft would release quantum systems that are capable of undermining global encryption is not only improbable, but also reckless, because it would destabilize not only cryptography, but also the entire digital infrastructure of banks, governments, and militaries. Cathie Wood reassures us that Bitcoin is not a fixed currency. Rather, it can be upgraded. In the event that quantum threats ever materialize, Bitcoin developers could implement security patches in the same way that they would for any other modern software. This would make the concern more of a long-term theoretical issue than a current threat. Instead of being caused by machines of the future, Cathie Wood emphasizes that the actual vulnerabilities in Bitcoin are caused by people. These vulnerabilities can be exploited through social engineering, phishing, and mistakes in key management.
The core PCE index, this is very important, a very important inflation metric to the Fed. And here you can see there was a little bit of stall in the 2.5% to 3% range, and it is starting to break down. You can see one of the reasons is here. Gasoline prices are moving down, certainly on a year-over-year basis. They're down quite a bit. And you can see trueflation. So this is the measure of inflation, real time, 10,000 items analyzed in real time or updated in real time. And a lot of people have been wondering if the tariffs would take this back into the 2 to 3% range. And it got us to 2, but the latest tick has been down to 1.8%. This metric tends to lead the CPI by, I think it's 60 days, if I'm not mistaken. So it would suggest there probably are some more inflation surprises. On this chart, real GDP versus productivity growth. So I mentioned nominal GDP is I think it's a little below 5%. This is real GDP in the purple. You can see it's a little below 2.5% as of the first quarter. We think it will continue to decelerate here. And typically, productivity accelerates as GDP growth accelerates, or as unemployment rate goes up and fewer people have to do more. So right now it's a bit sluggish, but if we're right as we get into a broader based or starting with a rolling recovery and maybe an economic boom in 26, we think this productivity measure in the green here will go to much higher levels than we've seen at the beginning of past cycles. You can see in 2020 we got to roughly 7%. We would not be surprised to see more of a burst given what's happening with AI and how many companies are beginning to flatten the hierarchy within companies, taking middle management out as more and more people can do much more with by harnessing these technology tools. Here are auto sales, just to update you on that. We had the burst ahead of tariffs, and you can see now where we are, that I think it's 15.7 million units at an annual rate, so we're reversing already, and we would not be surprised to see this drop below the 15 level again before the recovery starts. Here's a gauge of capital spending. The last time we presented it on a year-over-year basis. Year-over-year, it is starting to fall. You'll see what the AI boom and the power generation boom is doing. It's helped it to level out. But if those two areas are booming, then other areas are falling. And again, that's because of the uncertainty, all of the uncertainty around tariffs and taxes and government spending and so forth. On the next page, you can see the most rapid bounce in the trade balance ever in 1 month, in a 1 month period of time. So imports collapsing, I think they were down 20% in 1 month, is the reason. There was huge imports to avoid tariffs. That was why we got to such a crazy deficit level. It's coming back. And let's see what happens here. But what's interesting about this, the imports falling, imports rising is a drag on GDP growth. Imports falling is a benefit to GDP growth. The question is, where do they land? Are they pulled through in consumption, or do they land in inventories? If they land in inventories, and we think that's a more likely, more of them will land in inventories than will be consumed, then that's not a healthy source of growth. And here you can see, this was a very interesting report from this week. This is ISM of services. Now, services are a much bigger part of the economy than our goods. But here you can see price elasticity of demand really taking hold. Prices, they've tried to push those prices up. That's in the purple line. And look what's happening to units. And, services rarely fall unless we are in a recession. And you can see evidence of a kind of rolling recession, even in this metric, starting in 2022. So we think this response, units falling, is going to take away the incentive for companies to continue to push tariffs through in pricing.
The United States jobs report for the month of May revealed economic signals that were uneven but ultimately stabilizing. 139,000 new jobs were created by the economy, which was slightly higher than the forecasts, but still a slowdown from the numbers that were reported in April. It appears that there are no imminent cracks in the labor market, as the unemployment rate remained unchanged at 4.2%. The public sector was responsible for the majority of job losses, which is an interesting finding because it suggests that the private sector is still doing well. However, in spite of these numbers, the price of Bitcoin did not exhibit much of a reaction. How come? The reason for this is that the sentiment of the market is currently being driven less by the fundamentals of the economy and more by the ongoing political drama, specifically the very public and growing rift between Donald Trump and Elon Musk, in spite of the fact that the Federal Reserve is not likely to rush to reduce interest rates given the stable employment situation. Analysts believe that the real concern is inflation and the potential changes in trade or fiscal policy that could occur if Trump were to return to office. Strong interest rates could strengthen the dollar, which would put pressure on Bitcoin and choke inflows into exchange-traded funds, ETFs. This would occur considering that inflation is still sticky, and the Fed is being cautious.
I've been presenting this for a while. It's, to us, an astonishing chart. The ratio of metals to gold prices, new low. Even though silver prices, which is in the metals, have really taken off. So this disconnect between the metals to gold price ratio in the purple and the long-term treasury yield is being exacerbated here. We thought it would close with both of them moving towards one another, but that's not true. So this correlation has broken down for right now, and it's a correlation that's been in place for many, many years. Even pre 2008, the correlation wasn't as close, perhaps, but it was there, as you can see. And that suggests to us that there is more weakness in the global economy than many people appreciate. It's probably in China. We do see China exporting deflation in a major way. Just look at the prices of BYD vehicles. I think they've got some now in the $8,000 range, and they're exporting to Latin America, to the Middle East, to Europe. I was in Europe, saw BYD dealerships popping up all over the place. So I think there's more of an export of deflation taking place than many people understand. Here, market indicators. So again, there are bears out there who say we're set up for another period like the late 60s to the early 80s, where this metric, the S&P price to gold, collapsed. And that was in a major inflationary period. We do not believe that's what we're going through now. And you can see there's a tug of war if you look at the recent behavior of this metric. But it looks like the test has been successful, and it looks like the market, the equity market, has weathered so much controversy this year. The tariffs, the drama around the big beautiful bill, and the Trump-Musk battle over it. So we think it will resolve on the upside here, not on the downside, and that again, I think, goes against the grain. A lot of people are out there very negative about our deficit, our government spending, and we're not happy about it either. But we can also see a lot of reasons that growth is going to accelerate thanks to the massive amount of innovation taking place out there. Another metric that is pointing in a positive direction, unlike the late 60s to early 80s, is the S&P price to the oil price, and that's reaching for new highs, which is very positive. Crude oil going down is a major tax cut for most every part of the globe except for the Middle East, and so this is a very good thing to see. And of course, this week Saudi Arabia basically said, we want to keep our fair share. We're going to increase supply more. And I remember in the 86 period, this happened, and the oil price collapsed, and that was finally when people began to believe back then that inflation was not going to come roaring back. So let's see what happens here. Last few charts here. This is just a reminder of how much hard work the 10-year Treasury yield did over 40 years. And now we're getting back to what I would consider more normal. The 10-year Treasury yield tends to mimic the nominal GDP, and that's kind of where we are right now. If nominal GDP growth comes down, as we expect it will, we think interest rates will come down before all is said and done. But in terms of the range we would expect, we hope not to get into the 0 to 2.5% range again. That was almost heralding a very bad deflationary environment. And market signals, we lost all market signals. We want market signals, and the long-term bond yield is a very important signal. Here's the spread, the high-yield bond versus the 10-year Treasury yield. Again, closer to the low end of where it has been in the last 30 or so years. So the bond market doesn't see much risk out there. I will say I do subscribe to the risk that many people think is happening because too much money is pushing into the private credit world. And so this could be distorted, just too much demand for yield relative to supply. This could be where the bubble is. And so we'll see what happens there.
In conclusion, we will now discuss the larger political climate, which appears to be taking control of the narrative surrounding cryptocurrency. As a result of geopolitical tensions, culture wars, and the drama that is taking place between high-profile figures such as Trump and Musk, traditional market movers such as inflation, interest rates, and labor data are taking a backseat. Within the realm of market influence, this political distraction has reached such a level of dominance that it is even surpassing the influence of macro indicators. Nevertheless, the long-term Bitcoin thesis continues to be maintained despite all of the noise. A maturing investor base that is increasingly focused on structural integration rather than short-term speculation is indicated by the fact that there was no overreaction to the data regarding employment that was released. The markets, on the other hand, continue to be on edge because of the looming policy uncertainties, particularly in the phase leading up to the election cycle of 2024. It is possible that a second term for Trump as president would result in changes to fiscal and monetary policies, which would add an additional layer of volatility or opportunity depending on how it is managed.